This is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, April 28th, 2023. It's 10:36 a.m. Eastern Time as I'm starting the video, and this one will be brief. Don't want to beat a dead horse here, but it's Groundhog Day. We remain within the 1-month-old trading range. We've gone exactly nowhere but sideways for the last month in QQQ, and we are at now just officially hit the top of the range, almost to the exact button. If you look at the that previous reaction high, let me find a clean board, and I'll put up a line there for you. So there's our reaction high. Oops, that popped up a box there. Let me take that box. That was an old box. That was the peak high of the range so far, was back on April 4th, after already entering the range and started it in late March, and that was at a high of 321.63. Today we hit a high of 321.87, so effectively another tag, and there's another bounce. So it might not be what you want to hear, but that's it. And well, you might not like this. My best guess is, as long in the tooth as this range is, and remember about a week ago, I took a box of the range and I measured the distance. All you have to do on any chart is just take a horizontal line and to measure how long something took, and then you can compare it to other periods. Well, I just made a mess of that. Let me go back to that cleaner board here, and just showed you that it was already one of the longer ranges that we've had in years. It's for such a tight, distinct, clean trading range, and the MO is simple. You sell the bottom, buy the bottom, sell the top until it breaks. And admittedly, this was a breakdown. I thought it had the potential to stick, although there was that big take it with a grain of salt, because that breakdown came right in front of Alphabet and Microsoft earnings. And then as covered there, I watched that downtrend line. We rallied back to it, figured we'd get a rejection, and we did, and then we gapped above it, and that was it. So as I said in the video on what's today, Friday, so on Wednesday's video, so take out that trend line. It's going to increase the odds. We'll probably run at the top and possibly pop above the range. Now, here's where I'm going with this. The bad news is, if you've been frustrated in this range, and I don't see, again, if you're active trading, great. If you were able to, keep playing the zigs and zags, I maintain this thing's ripe to break down sooner than later. All I can tell you with absolute certainty is we're at the top of the range, which is resistance. That I can tell you with certainty. Now, with my best guess is, unfortunately, this range I think will probably remain in here. There's a decent chance through at least the middle, maybe even the end of next week. And the reason is, we have the Fed, the big FOMC announcement coming up on Wednesday, and that's after, they don't make the announcement until 2 p.m. Then Powell gets up there and does his dog and pony show at 2:30. That's going to cause some volatility, and just like this was a post-earnings, this was an earnings-induced whipsaw right there that proved to be a false breakdown and then a rally back to the top of the range. Any breakdown of the range between now and the Fed, and then even worse, is we have Apple on Thursday. Apple being the largest, component, or one of the teeter-totters with Microsoft in QQQ, that also has the potential to move the markets. That'll be the last of the big fangs to report. So therefore, that's it. We're looking at, maybe as long as this range has gone on, maybe another week. And if we do get a break above or below the range before then, again, the Fed meeting, Fed announcement, I should say, and Apple earnings has the potential to undo any breakout or reverse it. So that's it. Might not be what you want to hear. It just has, we have a lot of uncertainty. There's, again, they are well, Apple, of course, being the biggest. We have most of the fangs out of the way now. I'm going to talk on Amazon real quick. We know what happened with Apple and Alphabet. Alphabet's pretty much gone nowhere. I'll get to those in 1 second. But Apple is, of course, the last of it, and so we'll see where we go from there. And by that point, I was hoping we'd have some kind of a resolution which way the market wanted to break here, And all I can tell you, again, we're at the top of the range. Oh, we took out that trend line. I gave it to you on the 5-minute yesterday, and this is that same uptrend line on the 60 minutes. We're below it as well. So that's it. So at best, I'll give you my thoughts. At best, and I said it 2 days ago, that if we pop this line, that would probably most likely take us to the top of the range and quite possibly above there. So I still maintain, as of now, at best we pop the range, and if we do between now and next Thursday, it will, in my opinion, still prove to be a false breakdown. It'll be a divergent high. It'll be another whipsaw. We would just have an upside whipsaw. Now, if we start going up much more, you take away the divergence that's still in place on the 60-minute and daily chart, still very much in place. Those big fangs still have it. So again, I've done this a long time. What I've seen post earnings means absolutely nothing to me. I've seen these fangs rally as hard or harder, only to see that reverse. It doesn't mean, and I'm referring to Microsoft really. Microsoft was the one that ran, and Meta as well. Tesla crapped out after earnings, so it's kind of been a mixed bag across the board. Let's just go over that real quick. But again, I just wanted to point out Wednesday FOMC and Thursday Apple, and that is after the close. By the way, here's the I was surprised. I pulled up the I haven't been tracking it closely, but I knew as of a few days ago, I heard there was a 75% chance of another quarter point hike at Wednesday's meeting. And based on the economic numbers, the GDP came in softer. It shows a slowing economy. It was still a positive print, but showing a slowdown. And everything I'm seeing, especially with the continued pressure in the banks, I personally think the Fed will probably hold tight, but that's a tremendous contrarian bet. This is right now. These are the probabilities based on, this is the most accurate measure. People putting their money where their mouth is. This is CME Groups. This is the Fed Fund Futures, what they're pricing in. Forget about what any analyst says. This is where, again, that's just someone's opinion. This is where institutions, smart money, retail investors don't trade the Fed Fund Futures hardly. These are pros, and they're pricing in right now at 87.7% probability that we're going to get a quarter point hike. This is how you read this. The current rate is 4.75 to 5%. Or these are basis points, 475 to 500, and so there's only a 12.3% chance that they're going to sit tight, with an 87.7% chance of a hike. So I wanted to talk on this because especially with the pricing in, the expectation, almost a certainty or close to a certainty, a very high probability that is, of another hike. For whatever reason, and it wouldn't surprise me personally if the Fed sits tight, that would most likely cause a near-term explosive rally. So I got to throw that out there. Do not point that out, I'd be remiss. It's not my preferred scenario. Longer-term charts still tell me there's a big drop coming, but it's going to be, between now and next week, a lot can and will happen. And again, it's sometimes not what the Fed does, but more so what they say. Let's see what happens. Like I said, right now, this is all ifs and maybes. What I can tell you for certain, again, we're at resistance at the top of the trading range on QQQ right now. A couple other things I want to point out here. So anyways, we'll watch this, and this will change, and you can track this yourself. Just Google search Fed Funds Futures, or go to cmegroup.com, and it's under there. Let's look at a few of the fangs and make this a short video. Okay, so again, this is just a clean, simple board. I don't have all my lines like we have here, little micro levels and all that. That's the trading range on QQQ. There's the my daily chart with all the lines and annotations. That was a divergent high right there. And there's that trading range. You can zoom in nice and tight. Today's effectively equal ever so slightly margin. We're talking mere basis points. A basis point is 1/100th of a percent. So I showed you earlier, we went up pennies below that previous high from almost a month ago. And so that was effectively a marginal new high, which is still only a divergent high, even bigger divergence. And again, this is not the be all end all, but it is a big part of my trading, and much more often than not, when other factors align, these divergences play out for significant trend reversals. So that's why I still favor that big drop, 20-30%, despite the bullish tape over the last couple days. That's just noise. I call that noise around earnings you're going to get. And you look at it this way. We all see what we want to see. The move over the last few days, which was about a 3.5% gain in the Nasdaq off the lows, is no more bullish than the drop. That 3.5% drop leading up to it was bearish. It's a wash. So again, this is a trading range. We all have our thoughts on where it's going to go. Like I said, I'm comfortable and almost expect a little pop above it based on the recent volatility and the whipsaws. Maybe not, but I just want to share my thoughts. And then look, anything much more than a little marginal new high and a reversal back down into and then below the range starts to change things, starts to take away the divergences, starts to take away trend lines, and does things like this. Let's look at Amazon, for example. I got 1,000,001 lines here, but let me turn them all off or find a clean board here, and then I can draw on the clean board. Okay, first and foremost, Amazon rocketed last night on the initial. I always warn you over and over again, don't overreact or put too much stock into the initial reaction, and that's exactly what happened. It ripped in after hours on the initial report, then the conference call when they told that AWS was slowing, then that's where you saw 180 and the stock lost all those gains overnight. I don't have the intraday turned on right now, but and we're down. But what I wanted to point out is keep an eye on this one. It is only one stock, and I promise you this too, or don't promise, but can tell you with a high degree of confidence that if the rest start going up, if Apple goes much higher and blows it away, and not blows it away, Apple will. They always post record earnings, just like their new iPhone's always the fastest and best iPhone ever, and rarely does Apple miss. They're just an earnings juggernaut, but it's not. They often top on rosy and record earnings, and so again, it's the market's reaction following next Thursday, and that's Thursday after the close. So you really only have one full trading day, and that happens to be a Friday right before the weekend. So we may not have a really clear idea until early the following week, based on again what I just said. Fed is late Wednesday, Apple is Thursday after the close. That gives us one full trading day on Friday. The two things that would be very bullish for this market and could foil at least the near-term outlook, or bearish outlook that is, would be obviously anything coming bullish or any interpretation. Forget about what the Fed says or what they do, is how the market reacts to what they do. So let's see what the market does in response to the Fed on Wednesday, and then of course how the market reacts to Apple earnings on and guidance and outlook and all that good stuff on Thursday. But I wanted to point this out, that Amazon as of now, I always say one day doesn't make a trend, and most certainly 1 hour. We're only just over an hour into the trading day, and Amazon is back. See, they had a I always say this: never, ever take a breakout or a breakdown right before earnings. It has a much higher rate of failure. Doesn't mean it can't stick. It's just a good rule to go by is hold off because breakouts that occur. Again, this is from what I do on this site is share years of experience. Breakouts that occur right before an earnings report have a much higher rate of failing. Just why not wait till earnings out of the way? So that was yesterday. We took out the 200-day moving averages, and it was both the exponential, the blue line and the red line, or the exponential and the simple. Sometimes it's one, sometimes it's the other that caps the rallies, and I've pointed that out repeatedly. It's capped every rally in the bear market since we took them out. They were support as they always are, or typically are in a bull market. Took them out there, back test after the initial takeout, back test. again, we're in very close proximity. And what I was saying a minute ago, what I can tell you, there's a little uptrend line I drew. And if Apple and Microsoft or the majority of these and Alphabet and Nvidia and Meta and Tesla, again, the majority of those start going up in the coming days to weeks, they're going to pull Amazon up with it. There's just such a high correlation. Vast majority of investors now are indexing, 401ks and stuff like that, and so money flows into the indexes, and they just it's indiscriminate buying. It's money is spread out among all those names. I just wanted to say it's possible, but unlikely to see Amazon do this and the QQQ do this. Okay, but for now, it's worth noting. This was a kind of a rut row moment. Amazon popped above there yesterday. Again, was pre-earnings, so it meant literally nothing to me. And now we're below there, but we're below there by a very slight amount. We can get back above there. So really what the market I think is going to watch and what you want to see if you are bullish and want to go long, you have longs, you want to add to longs, or if you're short, you want to know where to cover shorts. One bullish development would be a pop over yesterday's high. So don't, if you have an alert set, if you cross the 200, you're going to get whipped. The 200, don't, it's not a minute by minute, day to day thing. You want to see a solid close above it. And then the farther you get away from it, the more likely any breakout above those 200s will stick. So that's it. So really, to be safe, now that Amazon put in a reaction high yesterday, that's where a lot of the stops and on shorts and buy orders are going to be, and that's right above yesterday's high, about 111. So I just want to point that out. And now there's an uptrend line as well that's now formed, pretty well defined, not super well defined, but 1, 2, 3, now 4 reactions. So a break of that would likely usher in selling. You can also see this yellow line I have here. That's the 50-day exponential moving average. I think you can see it. You had a perfect rejection right there off of it. Then you took it out here in a big green candle right through it. Back tested it 1, 2, 3. That's a green candle. Intraday break, solid close back above. So it trades well to the 50. 1, 2, 3 successful back test, and then boom, red candle. You broke it. Back tested from below, got rejected, fell down, rallied back up, hit it, rejected, broke above it, and it was on a big green candle. So I look for things like that. Not only, when I'm looking to see which moving averages work on a stock or which ones they respect, it is a combination of the number of reactions, distinct reactions above and below it, and then also when you break above it, you typically see that the buy programs come in. So this just shows that people and algos, computerized programs are buying that. So there's a level to watch as well. And you can see once you took it back with that big green candle, I think you can see it. But every now and then I get people saying they can't see these lines on the charts because it's most like your monitor brightness. But there it is. Beautiful line. And again, we've been above it. 1, 2, 3, 4, 5, reactions. So there it is. These are the levels to watch. You've got your uptrend line right here. Let me tighten that up nice and clean. 1, 2, 3, almost 4, 5, 6 candles on it. Then the 50. In fact, I will set an alert on both of those. And but the takeaway is, so you are above the 50 and you're above the trend line right now, and you're right for all intents and purposes right on the, you are not above them yet. Again, this is where we'll say the 200 days have been taken out above yesterday's highs. So that's it. I know it might a lot of talking for one stock, but that's a big one, because if it would be a red flag to see Amazon start going down, taking out that going down there, it would most likely mean the rest of the FAANGs will are likely to follow suit. So let's look at those real quick. Apple, again, Apple broke down below a very well defined uptrend line. That's this one right here in the big wedge. I talked about it, but it means also very little, if anything, that breakdown, because they report next week, and Apple's just trading in line with the indexes. Money was flowing in yesterday into the Qs, so it would be extremely unusual barring any other negative news or anything, to see Apple not go up. Again, it's just simple mathematic weighting when and the institutions and individuals are buying QQQ and NQ. Apple gets the lion's share of that money flowing into it, and they have to buy Apple stock. So that's that. And so whatever, it's back, right above the trend line. And again, anything that happens between now and earnings doesn't mean a whole lot to me. And but what it would mean if it fails, see this primary uptrend, downtrend line right here. Let me just color it up on a clean board for you so we can just do that real quick. Let's go here. There's your primary downtrend line right there. And we're not even that much above it when I draw it that way. That's probably the best draw right there. So we're, for all intents and purposes, right on there. So that's it. So I already have a price alert set on the uptrend line. I know where we're at in proximity to the downtrend line, and my convictions haven't wavered at all. Like I said, if the Fed next week and how the market reacts to Apple may change things, but as of now, I see one of the best potential shorting ops. I'm looking for the next leg down the bear market, and I know. After yesterday, I just know how this works. I've done this a long time. Most of you don't want to hear that or dismiss it, and that's fine. You go long here, but I can tell you that I can tell you certain things are my opinion, certain things are fact, and it is fact that we just rallied into resistance at the top of the range. And TA 101 or Trading 101 says you want to sell the top of a trading range and buy or cover your short, and then go down to the bottom and cover that short or go long. Now, that strategy again, this trading range, like I said, is very long in the tooth. Probably, sooner or later it's going to stop working. So just keep that in mind. But it has been the MO, and it may continue. And again, so let me go over a few more FAANGs, and I'll wrap this video up. So I already covered interest rates. I already covered Apple. The levels to watch on Apple, Microsoft. Strong to hit that next resistance level. That was a line I've had on here for a long time. That show value at 305.90. We'll call that 306. That was created back in 2021, that line, and we hit that. But we still have the divergence, and we had divergence, as I pointed out back here. We started to correct. And nervousness in front of earnings, but they liked what Microsoft was selling, and but that didn't, at least in my opinion, did not change the technical posture, because I look down here where we had a divergent high leading up to before earnings right there. That divergence is not only bigger, but it's steepening. You have the slope of the lines are actually is more steep right now. So you have higher highs in prices, a more of a steep uptrend line, or a stronger, higher slope, and then same with the downtrend lines. Now, look, divergence is not a sell signal. It's not guaranteed to play out, but I'm betting it will. All right, so that's Microsoft. There's Alphabet, and same thing. Put in a divergent high. Alphabet's been flat since earnings, so this one's gone nowhere. It's mostly Microsoft, really. Amazon, flat again. Here's another one that's just, crapped out after earnings. I just covered that. So all the giddiness seems to come from Microsoft. The semis, I already covered that yesterday. I said, you could hedge. A lot of them hit support and targets yesterday, but it's also a red flag, been weak. And Meta doesn't have the weighting. The market, yesterday's rally was, again, it was technically induced, in my opinion. It was that downtrend line on NQ and QQQ I told you about. They gapped above that, and it was a technical pop. Meta, in my opinion, and mathematically, shouldn't move the needle. It doesn't carry near the weighting that it used to in the Nasdaq 100. It's still one of the top components, but it's only 3. This was as of back then. April 10th, it was 3.67%. So it's not like, Apple is 12.2. Microsoft, again, that's back then, 12.7 on that date. All right, so that's that. In Meta, like I said, hit, Mount gap more. I mean, this is just a monster of a gap right there, gap resistance. And so, like I said, I think it's a lot of downside in this stock and very, very little upside. Post earnings pop was a little stronger than I figured because we took out that trend line. And look, I'm going to give it points. I'm going to always do the glass half full, glass half empty thing. I got to do it. It's my job to point out what's bullish. Okay, so Meta took out that trend line. But first of all, I need to say this. I've had that bear market downtrend line there, but unfortunately, it's really not a valid trend line. If I pull it down, I probably need to pull it down the best I can do for it, because in my book, it takes 3 distinct reactions. I've had it here. I figured we might get another reaction. That's why it was on my board, that we might get another reaction. I'm going to pull it down here. I have to cut it out some of the top of these candles, and that gives me at least 3 reactions, 1, 2, 3, because any 2 points can be connected at random. So I'm going to leave it here. That's, I think, the better fit. We're above it now, and we're also above the uptrend line off the lows. So what I'm watching for Meta would be a failure back below this trend line. This was a pre-earnings breakdown. Remember, take that with a grain of salt. Doesn't really count, and it proved to be a whipsaw. However, the trend line, in my opinion, is still very valid. We have a lot of reactions off the November low. So break below there, but then, you know, the glass half full scenario, even if that happens, would say we come back test the trend line, or maybe backfill the gap. They're both together. So let me keep it simple. Anything below this level here, below that gap, it's going to take us back below the downtrend line and have backfilled the gap and then some. This is how it, in my head, how it typically works and how it should work. On a pullback, the bulls should be coming in with both fists there on a gap backfill, if that gap is backfilled. And if it gets backfilled, by the way, that's going to be a hefty pullback. It's going to be a 10% drop. Keep that in mind. The most bullish thing would be to see the stock just keep going, power through resistance. I put odds on that at pretty darn low, but that's just me. Anywho, so those are the things to watch for. And so, you know what I'll do? I'll set an alert right now, right around the gap, and you know, if that happens, we'll know. If Meta drops 10% before we even get down there, you're going to know about it. The market will be down most likely. All right, there's Tesla. You know, Tesla's oversold near term. Surprised to see it going down as much recently. So of course it was up. Yes, it was oversold, and you get, you know, oversold. Then there's a big rally in the market. The buy programs are going to hit. You get the little 60-minute divergences. You get a bounce. I have very little opinion on Tesla right now. If anything, you know, I'd probably be, if you were looking to go long anything in the Nasdaq 100, I would short those at resistance like Meta and maybe even Amazon, because it's below the 200 with stops not too far above the recent highs, and be long something like Tesla. But I don't want to be long any of them right now. Really, that's it. You know, if I keep going from here, I'm just talking. This is you know, the Nasdaq 100. Just like I started the video with QQQ, there was that previous high from early April. We just hit it. And this is the range here on NQ. So what I said 2 days ago holds true. We have to, the next real, and to me very powerful sell signal will be a break of Tuesday's lows, Tuesday of this week. That was the breakdown there, right there. So that's going to be where I can almost assure you a lot of stops on longs that bought once they saw the recovery back above there, especially yesterday's breakout above the downtrend line. That was you know, again, that was a technical catalyst to send us back to the top of the range. And you know, so that's it. So the next stop's probably the bottom of the range. At best, we pop and get, like I said, a little marginal new high, but expect volatility between now and next Friday, really, you know, with the Fed on Wednesday afternoon and Apple Thursday after the close. All right, I will wrap it up here. Those are the levels to watch, and I will continue to hunt for individual trade ideas. And before I wrap up, even though I just said I would, I forgot I should cover the VIX because it's part of the everything. Just like the stock market has that big negative divergence on the daily, that divergence on the VIX just grows larger and larger. We have clean, unmistakable positive divergence. We had a divergent low there, gave us that rally, and that divergence, we came in, made a marginal new low, even bigger divergence now. So all this, if Tuesday's lows go, if the market doesn't like what the Fed is selling or what Apple is selling next week, for whatever reason the market drops, if it takes out Tuesday's lows, by the time it even gets to Tuesday's lows, I'll bet you it'll be up here at least, and then it'll break out. That would be a breakout right there, because that was our recent reaction high. And then if we do get that next leg down, I'm talking about 20-30%, the VIX is set to explode, on a big divergent low like this. Last time we had one was just before the bear market started and before the bull market ended back in July of 2022. I'm sorry, July of 2021. And then if you remember, the Nasdaq 100 peaked right here in what was it, October, November, somewhere around there, and right around this time. But we already put in the divergent low. We had the first pop, came up, made that low, and then boom, boom, boom. All right, 30 minutes. I'm wrapping it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.